In this video, I'm going to talk about how to account for late payment fees when a company purchases something on credit but doesn't pay the bill on time. So let's say that a retailer purchases a case of sweet corn soda for $100 on credit. And let's ignore sales tax to keep things simple. When the retailer receives the soda, they're going to make the following journal entry. They're going to debit inventory for $100 and they're going to credit accounts payable for $100. With accounts payable, of course, being a liability that recognizes that the company still owes $100 for that inventory. Now, here's the catch. Let's assume that when the bill comes due, the retailer does not pay the bill. Okay, so now they are late, they are delinquent on this bill, so they receive a new invoice saying that they owe $105 now because there has been a $5 late fee that has been assessed for not paying the bill on time. So they still owe the original $100, but now there's an additional $5 tacked on as a late payment fee. So the question is, how should the retailer account for this? Well, what's going to happen is accounts payable is going to go up because now they owe more money. So we're going to have to make a credit to accounts payable for $5. But then the question is, what do we debit? Well, you might find some people who say, well, maybe you should debit inventory, or maybe this late payment is really a form of interest, so you should debit interest expense. Or maybe they just say, you know what, accounts like this, we just put this in miscellaneous expense. But the best way to account for this is to debit a late payment expense account. Okay, and that's going to allow the company to more easily track what late payments they've had over the course of the period. Maybe you see that over time the late payments are increasing and so forth. So you really want a dedicated late payment expense account set up in the company's chart of accounts. So let's assume that that's the case, and then we're going to debit late payment expense. We would debit late payment expense for $5, and we would credit accounts payable for $5. Now, what if, I'm going to give you a hypothetical scenario here. What if the late payment occurred because the retailer had lost the bill? Like, so they originally got the bill for saying, hey, you owe $100, but they lost it. The accounting department never made that initial journal entry. And when I'm talking about the initial journal entry, I'm talking about this one back here. Let's say that the accounting department had never made that journal entry, and then later they get this thing saying, hey, you have this late fee. You owe now $105. So in that scenario, here's the journal entry that you would have. Okay? You would debit the inventory account for $100 because you never made that initial journal entry. Then you would debit late payment expense for $5, and then you would credit accounts payable for $105. So we're basically combining the journal entries into a single journal entry, right? So before, had you originally debited inventory for $100, credit accounts payable for $100, then you would come in and debit late payment expense, credit account payable. But I'm saying, had you never made that initial journal entry, and then you say, oh, okay, we never made that initial journal entry. Oh, I guess we're late on this bill. You have to debit the inventory account and then credit account payable for the 105 because you never credit account payable for 100 before in that hypothetical scenario. Now, in either case, whether they originally lost the bill and never recorded the initial journal entry or what happened, when the retailer actually goes and pays the bill, they're going to debit accounts payable for $105 to remove the liability, and then they're going to credit the cash account when they actually pay the bill.